Hello, everyone. I'm Thane Rosenbaum. I'm the creative director of the Forum on Life, Culture, and Society at Touro University, and welcome to the FOLCS Headline Series. Tonight, bank runs and bailouts with our special guest, former FDIC Chair Sheila Bair. She was, as you'll remember, everyone now knows, she was the chief banking regulator during the Great Recession, the financial crisis of 2008. Remember those days when we learned new terms of art like too big to fail and moral hazard? We had not known that before, and she helped navigate us through that. Why is this important? Well, the headline series, which is new to folks, although we've done some really wonderful ones over the last several years. We did one for the Ukraine war and the Iranian protests. This is clearly another one ripped from the headlines up to the minute. We've had another banking crisis, and we'll hear from Sheila on how big a crisis this actually is. We now know that too big to fail might apply now, or is it maybe too small to withstand the flight of depositors? Not sure which it is, but Sheila will explain that. We've had two bank failures, Silicon Valley Bank and Signature Bank. We've had rescues of First Republic and Credit Suisse. What is going on here? We'll find out. If you're watching us live on YouTube, welcome. We love that you're joining us. Don't forget to go to folks.org to sign up for our email list. You'll get notice of future events, and you'll be able to find out how to watch this event again on our YouTube channel and on our website. If you've got a question for Sheila, you can leave it in the Q&A box, and hopefully we'll have some time to get it. Sheila, welcome. Welcome to Folks.
Thank you. Thanks for having me.
So yesterday, the Federal Reserve announced a rate hike. Not your favorite, not your particular favorite news, right? I want to start with that because it's the most recent thing that happened. And maybe you can explain the significance of it's happening and why you don't like rate hike, especially now.
Right. So actually, I am an inflation hawk. I was go back to 2010. I was calling for the Fed to normalize rates. I think extremely loose monetary policy, you take rates down to extreme levels when the economy or the financial system is in stress, then you move to normalize because you get all sorts of distortions in the allocation of capital if you keep interest rates so low. And we kept them really low for almost 14 years. So I've been a longstanding critic for that. However, I recognize that after 14 years of lax monetary policy, you can only do so much so fast to undo that. I do think the Fed's been going too fast. I called for them to pause last December. I wrote an op-ed. I the back of envelope calculations, they started it, I think, as 0.08%, the Fed funds rates, which is the short-term rate that they manipulate to tighten credit. It was at 0.08% when they started. It's now north of 4.5, will be north of 4.75. That's over 6,000% increase. I mean, that's a huge increase. So you look in absolute terms, maybe they don't look so high in historical terms, but if you look at where they started just, a year ago, it's been a huge jump. And it's not just the financial system is having a hard time absorbing it. It's the economy is having a hard time absorbing it. Labor markets in particular, rate hikes, they hit every corner of the economy. They raise borrowing costs for everyone. They tighten credit for everyone, and really put the labor markets in particular in direct in the direct line of fire. So I'm glad they slowed down. At least it sounds like they're going to be very judicious about further rate increases. We'll see what happens. But I wish they just hit pause now. I think, again, they've just gone too far too fast.
So we had Larry Summers a number of months ago. And of course, he's widely credited with predicting the inflation rate rise in the aftermath of the COVID packages. So in order to understand how these all tie together, you would say that the rate hikes have also something to do, right? The rate hikes, which are designed to temper inflation, may have precipitated these bank failures.
Yeah. Well,
this certainly explain why that is. It's because I think most people don't exactly understand what banks do and what they invest in.
Right. So a bank, so let's, everybody's seen It's a Wonderful Life, I think, with Jimmy Stewart. So, when you deposit money in a bank or a thrift in that case, the money just doesn't sit there in the vault. The bank keeps some of it back to make sure they have, plenty of cash on hand to meet deposit withdrawals. But most of it is either put out, lent out in loans, or it's invested in securities. And so, but when you invest, but assets, particularly bonds that are old, that have really low interest rates, low yields, because just a few years ago, interest rates were really low. Now interest rates are going up a lot, really fast. And as they go up, the more they go up, the faster they go up, the quicker those bonds lose market value. So that's okay. If you can hold that bond to maturity, right? You'll get your principal paid back in full and you won't have a loss. But if you have to sell it early, if you have to sell it into the market, when investors know the newly issued bond is going to have a lot higher interest rate than that old bond you're selling, you're going to take a significant loss. So this is what happened with Silicon Valley. It wasn't so much an issue with Signature Bank, but this is what happened with Silicon Valley. They loaded up an 80 billion plus government securities that, from a credit risk standpoint, from a risk of default, there was no risk of default. These are government-backed securities, bonds and mortgage-backed securities. They were safe, but they had relatively low interest rates compared to today, and they invested them just at the same time that the Fed was going to start raising rates. And then so that's called interest rate risk, and you can manage that, but they didn't do very effectively hedge it. And they put most of those securities investments in something called a hold to maturity portfolio. That's a fancy word that basically means what it says, which is a bank puts the securities in that, it's an accounting, portfolio. You're going to hold them to maturity. So
but I'm sorry, Sheila. That means that they are self-regulating themselves not to sell it early?
Well, there should be, the accountants are supposed to review this. The examiners are supposed to review this. Because if you put these securities in what's called the hold to maturity, HTM portfolio, that means you do not have to mark them down to what their current market value is. You do not have to recognize a loss. You do not have to deduct that from capital. You can keep them on your books at par. You do not have to reflect any loss to market value. And again, that's fine if you have the intention and the capability to keep them to maturity when you can redeem them for par.
But if you need them.
But you can't, if you have to sell them to, guess what, for a deposit run. And Silicon Valley had a highly volatile deposit base. It had, so insured deposits, there are insured deposits and there are uninsured deposits. Right. So there are deposits most of us have that are FDIC insured. Your deposit accounts are below $250,000. You don't have to worry a whit because the FDIC has a perfect record of protecting those insured deposits. But larger, really rich people and larger businesses will have significantly more than 250,000, and over 95% of their deposits were in this uninsured category. Not only that, but it's what we used to call hot money at the FDIC because it had pretty high, they were offering pretty high interest rates. So these depositors were partly banking there because they were getting a nice interest rate on their deposits. But also there was kind of this very close relationship with the bank, with these venture capital firms, the venture capital investors, and then the companies that these venture capitalists invested in. So then they had kind of a very cozy relationship with this bank, and this bank would make loans to the portfolio companies that they were funding, et cetera. And the bank had grown very quickly and it was very poorly managed. So when these venture capitalists, and this is the A list of venture capitalists.
Well, that is one of the things I want to ask you. Isn't there a presumption that if you've got at least $250,000 in a bank, you're not the kind of person that's going to run? Right? That you're not. Again, right. You can help explain to us because you were the chief regulator. We originally had $100,000 insurance, and it was $250,000.
Right.
Are we now to understand that $250,000 is not a lot of money? Because we're talking about people that had way more than $250,000.
Billions and billions. That's right.
Billions of dollars. Did they not understand that money was at risk? Did they create some illusion that even though the number is 250, it's actually higher than 250?
Well, as you know, I write children's books on money basics, and any school child who has gone to a bank with their parents knows there's a little sign by the teller that says deposits insured up to 250,000. The FDIC requires that. It's on the websites. It's everywhere. It's on your statement. Everybody knows there's a deposit limit.
Except computer scientists. Except computer scientists and venture capitalists.
Guess so. So I need to write a children's books for venture capitalists on how banks work. If you take all the money out at once, you force the bank to close, which is basically what happened here. Because they had, it forced a fire sale of these securities, and
Yeah.
they were experiencing significant market losses. It was $40 billion in one day, which is pretty amazing for a $200 billion bank. So yeah, that's basically what happened. Yeah.
So does moral hazard apply to smaller banks? Is that the lesson, number one?
Yeah.
And number
yeah.
two, is the idea that that even though the mortgage-backed securities and subprime mortgage crisis of 2008 that you helped lead us out of it, that even though the smaller banks were sort of left out of the consideration, they acted as if they were too big to fail?
Yeah. Well, yeah, I'm not sure. I think there's a lot of confusion out there now, because Dodd-Frank, which I supported, has tools. It does have tools. They need to be used. It has tools to prevent future bailouts, and that was the billing. We all said that. It's that Dodd-Frank was going to stabilize the banking system. It was going to prevent future bailouts, and then lo and behold, we have a $200 billion bank. So Silicon Valley was a $200 billion bank and a $23 trillion banking industry. The regulators said it was systemic, and therefore the uninsured depositors were very, for the most part, there was an allegation that there were a lot of small startups that needed access to their checking account to make payroll.
Yeah, but
maybe some of that was true. I don't know. I'd like to see some data around that. It would like
can I hold on a second? I just want you to go back a moment, because this is definitely something that you've been talking about a lot lately,
right?
That you would have carved out the idea of payroll.
Well,
right. You would
in times of turmoil. That's right. So a couple things, and I don't know if we need to do that yet. I think it would be prudent to let the FDIC have the ability to do that if we start having wider scale deposit runs. But even when there's no protection for uninsured deposits, it is almost always the case, and certainly would have been the case here, that the FDIC can pay uninsured depositors a very sizable dividend. It's advance payment. They do a quick calculation of what they think they can recover by selling the bank, selling the assets. They do a quick calculation what they think the recoveries will be for uninsured, and then take some discount from that, take a little off of that, and then pay an advance dividend. That's
I'm just sorry. You're saying, do you take your 250,000 and then you get some kind of a dividend, and that in the end is much less than pennies on the dollar?
Well, that's right. So your uninsured portion of your deposit, you always get, you get, within one business day, you get access to that. So insured deposits are always protected. And then say, you've got $1 million above that, that's uninsured. Now some of these accounts were, as I said, billions and billions. So let's just, for easy math, you got $1 million above that 250,000. Most of the private market analysts were suggesting that these uninsured would have gotten at least 80 cents on the dollar. So they would have gotten 800,000 out of that million. So
then why did
that wasn't enough. They wanted it all.
You're saying Signature and Silicon Valley Bank could be operating today if people didn't run and just accepted the 80%?
I think they could. Yes, these were liquidity failures. Now these banks had other problems, but they probably would have had time to work out their problems if they hadn't had a deposit run. If their depositors had remained loyal and stayed with the bank, I think they could have. It's a very, who knows? But it's, from what I've read, I think there's a very strong likelihood they could have worked out their problems. Yes. So these were deposit run. The reason
that's important is because you lived through and navigated us through a time where the word toxicity was talked about a lot.
Yes, right.
Packaging, banks and securities firms creating toxic mortgages and little derivative packages that they could sell that was just essentially, junk. But that's not what happened here at all, right? I mean, that's what the part I think many people are confused, that this was a bank run, liquidity problems, that in fact, the banks actually had assets, right? That they did. It's not right. They actually had assets. I think for some people, there is an enormous confusion of, well, how could the government just simply stop people from running to the bank? Just say, stop, because you're going to cause a really big problem. So go about your day. Do not panic. Just do I just want to understand, could we have avoided this?
No, that's an interesting question. Well, I don't know. I think that really puts the government, telling governments typically don't. I think governments generally provide assuring public assurances about the safety of the system. FDIC, as I say, insured deposits are always protected. For a government to go in and tell depositors not to run, though, that would be extraordinary. I've never
Okay.
heard of that. That's really not has not been government's role, and I'm not sure that it should be government's role. I think the banks, first of all, this bank should have had a more diversified deposit base. So most banks, so people listening to this should be assured, because most banks are have a majority of their deposits that are assured. So those do not run because people have confidence in the FDIC. Actually, during the great financial crisis, when I chaired the FDIC, money was going into the banks, not coming out of it. Money was
Right.
going in. There were no bank. There was a reverse run. They were going
Right.
in because they really believed in that deposit insurance
Right.
guarantee.
There was flight. It was
That's
the
right.
flight to some safety. And
That's
they
right.
saw, right. They saw the bank as safe.
It's the basic. But even for uninsured deposits are important to our financial system, our banking system. And those are good deposits too. You want to mix, you want a good solid base of it insured. And then your uninsured are hopefully, larger depositors who have been with you for a while, who are loyal to you, who know the bank, understand the bank's management, keep a watch on their financial statements. There's lots of call reports. If they're publicly traded, their financial statements, there's lots of financial data out there. The more sophisticated depositors, these very large depositors, can look at. And we want them to do that because as we've also seen with Silicon Valley, bank examiners work hard to do a good job, but they are imperfect too. They don't always catch things. And you want that market discipline that comes from the uninsured depositors, that larger, deep-pocketed, more sophisticated uninsured depositors, exercising some market discipline on that bank too. So that's the system. And the 250,000 is more than enough for the vast majority of Main Street households. They don't need to worry. But for the larger depositors, we want them to keep an eye on the banks.
And even for
in addition to the
smaller
examination
ones,
process.
Sheila, even smaller depositors, not billionaires, but smaller,
Right.
a millionaire, a person has $1 million can simply go to 4 different banks.
Well, they can. And actually there are.
Right, just divide it up 250 to every single one.
Yes, that's right.
And then
so it's 250 per bank. That's right.
And do people not do that?
Well, they do that, they actually, and even so even through account structuring, you can get well over $1 million of insurance, even at one bank, depending on through joint accounts or having trust accounts for your kids. So there are a lot of ways if you want to have a lot of money, and there are these things, deposit sharing services, where actually if you have a lot of money, you want to keep it in a bank. They'll break up your deposit into $250,000 increments and swap them out with other banks. So there are tons of ways to get plenty of deposit insurance for Main Street households.
And you're saying most people just don't do that or didn't.
They don't, but they don't. Well, they don't need to. If they're under 250 in their bank,
right? They don't even think of that.
The vast majority of people are. So it's really for the smaller businesses and maybe wealthier retired people who really don't want to be invested in securities and things. They just like the safety of a bank. But the point is there are options that are more than adequate to help households keep their money safe. They want to keep most of their money in a bank.
So as probably one of America's most famous bank regulators, and I'm betting on you as a future Treasury Secretary, Sheila.
Well,
you may not want the job, but I'm betting on it.
No, I don't.
But I actually wonder what your view is of when President Biden announced to the country, I think it was a Sunday, after the failure of the 2 banks, saying, just want to be sure, don't, all of your money is safe, everything,
Right.
and this is not a bailout. It seems to me like a bailout, why are we not calling it? We called tonight bailouts. Isn't it a bailout? And why would he be saying that? Because he just doesn't want people to think it was like 2008 when bankers investment bankers paid themselves bonuses.
Right. Well, it was a little. So the very largest banks, we really bailed them out. I mean, hardly anybody even lost their job, for heaven's sake. And shareholders took dilution; they weren't wiped out. Bondholders were protected. They were really bailed out generously, in my view, far too generously. So
you would not have done this.
So So this was much more severe. So everybody top management got fired. The equity holders and the bond holders, who are, if anybody out there understands bankruptcy and the priority of claims when something, So the common equity always goes first, and then unsecured debt above that. So that got wiped out, or that is at risk for getting wiped out. But they stopped there and protected all the uninsured. And no, I do define that as a bailout, because like a bailout is when you break the rules to give somebody something extra that other people aren't getting. And that's what they did. During the Great Financial Crisis, we tried hard to market banks that were failing to other healthy banks who would bid on the whole bank, including bidding on the uninsured deposits, to pay us enough to justify covering those uninsured, because I didn't want to impose losses on them either. It's hard, but those are the rules. And there were instances where households did have to take losses. I remember a woman who had sold her house and it deposited all the proceeds in IndyMac Bank when it failed. And she lost tens of thousands of dollars. She was a policewoman. That was real money for her. And so, yeah, it kind of makes my blood boil when the very well-heeled, rich billionaires, and they were all over Washington. I'm sorry, they were calling everybody. They say they weren't. That's not true. They were really, pulling all their strings that they could to get protected. And I don't think it was their influence so much. I think it was regulators had to make a quick decision, and they made a decision that I think was wrong.
And the decision
but I do.
Yeah, go ahead.
Please.
Sorry.
No, it's just that this is why people get upset. It's this sense of two different rules.
Right.
If this was some community bank, or if this had been IndyMac Bank, a $15 billion bank, those uninsured depositors would not have gotten bailed out. But this A-list of venture capitalists did. And that is troubling. I find that very troubling.
I think we've heard this word systemic a lot, Norman.
Yeah, we have.
And I do think systemic has confused people. I know I've written about this in the context of racism. I definitely think America has racism. I'm not sure it has systemic racism. And I'm not sure here, and I wonder what you think, that maybe that the argument here is that this isn't a systemic failure, that this was a discrete one example of failure, but that we rang the bell and allowed a regulatory assistance that really, as you described, was overly generous and probably inappropriate for the situation. And when you use the word systemic, people immediately start running.
They do. Well, that's right. I wrote an op-ed in the Financial Times. I basically made that argument that I thought this is not systemic. These are two very poorly managed banks. They were not big by any stretch of the imagination. They had good assets, so you could have paid a size.
And you're saying it didn't foreshadow anything.
No, but then saying they're systemic, holy cow, what's going on? And so then, okay, well, are they seeing deposit runs other places? That was kind of the narrative. Well, we got to do this, but that didn't prevent, as we saw, that didn't prevent uninsured. There were other banks under distress that had these same kind of problems. And that's the way the system works. Sometimes banks do stupid things, and they come under pressure and they need to correct themselves, or sometimes they need to fail. Banks fail. That happens. That's happened throughout history. And to say that we can't allow a couple, two relative small banks, their uninsured depositors can't take a small haircut, or we're going to have a system-wide problem. I don't think that was just beyond the pale to me. And
you're saying it actually leads to bank runs.
Well, it was unsettling. I had to wonder what the heck's going on. So I do think, as I said this up into, if they think there is a problem with widespread runs, I don't know if that's true, but if they are, there was a crisis era program we had called the Transaction Account Guarantee that didn't provide unlimited coverage for all deposits, but it did for those really important ones. Those transaction accounts are used for payroll and
that's what you were saying, operating costs, right?
Operating costs. So there's a good reason in crisis, in turmoil. I don't think we're in a crisis. Let's just say uncertainty or turmoil. There's a good reason to protect those, because those are important to the real economy. We want people to get paid. And those invariably have to go above the insured deposit limits, because a lot of money is going in and out, depending on what time of the month, whether they're making payroll, et cetera. So we gave them an unlimited guarantee for a temporary period of time during the Great Financial Crisis. It worked beautifully. When the community banks then were getting uninsured deposit runs, primarily from these types of accounts, that was going to the big guys, and that's not what we wanted. So it was very successful. We invoked it with a systemic risk determination. For whatever reason, in Dodd-Frank, Congress decided, this is good, and the FDIC should do this, but we want to be able to approve it. So now there is a fast track procedure to approve giving the FDIC the authority to initiate that kind of a program again.
Without congressional authorization.
But you need congressional authorization now. And so that's another problem.
But did that happen? It didn't happen here.
The president has to ask for it. And for whatever reason, I have been told that he's not asking for it because he thinks that would settle people. So we can say Silicon Valley Bank systemic. We can't say we're going to protect transaction accounts. I don't get that either. But they're smart people at the White House. They've got something figured out that I don't know. But the president needs to request it. But the president requests it. It's on the rocket docket. It's got to be held at the desk in the Senate, the House, 10 hours debate, up and down vote, simple majority. It's a very tight procedure that I think they could invoke to give the FDIC the authority to do that. And I do. So the problem now with they are trying to imply, I guess, because they're worried about uninsured deposit runs, they're trying to imply they're providing an implicit guarantee that uninsured deposits are protected. They don't have the legal authority to do that. That's what I'm worried about. Every time a bank fails, they're going to have to do a systemic risk determination that requires a supermajority vote of the FDIC board, the Fed board, the Treasury Secretary, the president. I don't think they're going to be able to do that every single time. And by signaling, trying to imply to people that their uninsured deposits are protected, they are encouraging complacency and without the legal ability to actually protect those deposits. So anybody who's listening to your show, stay below the insured deposit limits, please. Unless you're a big sophisticated depositor or business with long-standing relationship, understand your bank. And the vast majority of the banks are fine, especially the regional banks, they're fine. But if you're a household, you don't have time to go through a call report or a financial statement. You should stay below the insured deposit limits. If you're below 250,000, you're fine. If you're above it, go to the FDIC's website, and talk with your bank, see how you can structure your accounts to stay below those limits. Because there's no legal authority right now for the government to make good on any kind of implicit promise that you're going to be protected. It's just not there.
And that promise implicit without legal authority clearly, once again, creates moral hazard, right?
It does create moral hazard.
It sends all the wrong messages.
It does. It does. It absolutely does.
There's no risk here that you don't have to be an adult. You don't have to read money tales from Sheila Bair. You don't have to read it to your kids at night. Right. That you don't have to do anything, because if you just call the right lobbyist, call your congressperson, they'll make sure that you get bailed out. I'm wondering, here's something that didn't exist in 2008, digital banking.
Yeah.
It just seems to me that for you, this must have been an enormous surprise. I remember going to the US Open a number of years ago, and Chase Bank had a booth, and they were showing you how you could deposit your checks on your phone. It was like, because they were one of the sponsors of the US Open. And I think everyone was over there. What is that? Like, that is cool. You don't have to go to the bank. And I think people take for granted now that it's when you're making a bank run, you can really do it fast with your app. And also, if you want to scare the hell out of people, you can really do it on social media.
You can.
The digital world made the whole experience of banking much more volatile and scary, right? The irrational fear that you've been talking about, I think, has been compounded by the digital world. Is that something that seems very different for you?
Well, it does. And I think that's something regulators, examiners, and bank managers need to take account. During the Great Financial Crisis, actually, if you just look at it historically at uninsured deposits traditionally have not been subject to wide-scale runs. They've usually been what we call sticky.
So you're saying that did not happen in 2008?
That did not happen here. And I think that's one of the, so again, Silicon Valley, they'd grown way too fast. They're paying high, they're paying high interest. They had disloyal depositors. There were a lot of things going wrong at that bank. But just in general, the idea that even uninsured deposits are pretty stable, I think that is still mostly true, but it needs to be reassessed in light of the rapidity with which, bank scares can travel so quickly in social media. and how and the speed with which the money can be taken out. Now, it's still kind of clunky to take large amounts out, and a lot of people at Silicon Valley were caught. So they wouldn't have been lobbying. They were all trying to get out. They wouldn't have been lobbying for a bailout if they'd all been able to get out at once. So, with very large wire transfers, it'll take an overnight typically. So that it wasn't that fast. There was still some the inefficiency of the system actually kept some of the deposits in there. But yeah, social media was very detrimental.
So the stress test and the liquidity and capitalization requirements that we saw in Dodd-Frank,
right.
did never apply to small banks? Is that something we need to understand?
Well, yeah, there's been so this goes to the issue of what size of bank is quote unquote systemic for enhanced supervision and regulatory requirements. And so there's a lot of debate about that. I think in 2018, Congress passed a law basically giving the Fed the authority to to raise the definition of what was systemic. So it had been 50 billion, and so they basically tiered, and unless you were if you're below 250, you got a more streamlined regulation, let's call it. So there could have been things that could have been done better there, but I don't think that really wasn't a driver here. There are some changes that need to be made, and I opposed some of that law. I supported other parts of it. But the problem here was just really bad risk management in light of rising interest rates are creating a challenge for all banks. They need to manage that risk. Welcome to banking. Interest rates go up, bond prices go down. I need to write a book about that. That's pretty basic.
You're saying that's pretty straightforward, right?
And banks have a lot of bonds.
When
so the regulations actually encourage them to buy government securities, which is something else that we should take a look at.
When did it happen that people of considerable wealth decided that it's one thing to invest in a stock or security or even a bond, but it's another thing to put my money in the bank regardless of the insurance levels? In other words,
right. Yeah.
that did something happen, I wonder whether this is whether Money Tales is this among your stories for children.
Right.
Take your money to the bank because your money is always safe.
Right.
I mean, where
Right.
did it become that even sophisticated investors somehow believed? And remember, over the last, since 2010, with interest rates so low, right? People were looking, where to park their money.
Yeah.
Right. And so
Yeah.
banks just didn't even seem to be the place to do it because you had
Yeah.
such low interest rates.
Yeah.
So
Right.
is it because the interest rates were so low that they thought, I can't lose money here? They're not even giving me any money for it. I might as well keep it under my mattress.
Yeah. Yeah. I don't know. I mean, they were getting paid a pretty good interest rate. I mean, I looked up on bank rate. You could look up the deposit rates to banks. And Silicon Valley was paying a pretty high rate. Certainly,
And
higher
that
than
was
what I'm
as a
getting on-
draw, as a regional bank, they have
that's
the
right.
authority.
Well,
They have the
and I
authority.
think-
They
Yeah.
have the authority to induce you in.
Right. And I think there was a very cozy relationship with the depositors and the bank managers. And, I think that there's not a lot, I think there's some investigations around that, and, whether the banks were making loans to some of their portfolio companies and how good were those loans. And so there's more to be, I think there's a TBD there in terms of what was
And is
going on
that a
with that bank.
California regulatory issue?
So there was a California state chartered bank that was also a member of the Federal Reserve. So it was shared regulatory authority between the Federal Reserve Bank of San Francisco, yes, and the California banking regulators. So, and they did, I think they had opportunities for improvement here, no doubt about it. There was some pretty obvious things. It seems like, of course, hindsight's always 2020, but just what's been in the public domain, there have been a lot of problems for some time with this bank, and it is kind of surprising that they did go on as long as they did and ended up with a failure.
How does someone, and certainly banks, manage interest rate risks? Because one of the things that you've been talking a lot about, you said it again on this show, you said,
Right.
hey, rates go up, these
Right.
values of old long-term maturities go down, and you've
Right.
got to figure out a way,
Right.
the reason I'm asking that, because I know I've read that you said somewhere, the bank runs that result in moving people to bigger banks is terrible, because we want smaller banks to be
We do.
around to loan to
Yeah.
startups. That's
Yes.
why Silicon Valley Bank was so popular and why
Yeah.
Signature was popular with crypto companies, because
Right.
they're saying we're open for business to help you when these big banks tell you to take a hike. So I
Right.
think people don't appreciate how significant it is to
Yeah.
lose the smaller banks or to
Yeah.
disincentivize people to
Yes.
leave their money in smaller banks because fleeing for insurance, or because these guys are too big to fail. By the way, I don't even think that's true anymore. Now we're
Mhm.
learning no one's too big or too small to fail.
Yeah, well, there's a lot of confusion about that. So you're right. I mean, to the extent, so when the deposits run, where do they go? They're frequently going right now. They're going to JP Morgan Chase.
Right.
They're going to the multi-trillion-dollar banks, and not that these are all financial institutions, but I don't view them as any better managed than most of the regionals too. I mean, most of the regionals are quite good. They were very stable during the crisis. They kept lending. The great financial crisis, when I was chair, they kept lending. When the big banks were pulling back, those regional banks, community banks kept lending. That's been tons of research on that. So they help us. They provide some resilience in downturns. We've got to keep that sector healthy and thriving. So yeah, having deposits flee and making those big banks even bigger is not a good thing. So we need education, and we need assurance. And I do some of the earlier question you asked about this 2018 bills, because there's been some narrative that somehow there was some big deregulation of the regional banks. That's just not true. There were some changes. There's some provisions that should be strengthened, clearly, but all banks are facing interest rate risk, all banks. And there are ways to hedge that. Back to your question. So if you've got a volatile deposit base, you think, you've got a lot of deposits that could run, you need to stay invested in T-bills, right? You don't have an interest rate risk. Those are highly liquid, very short-term, good yields right now. Or you can get a swap. There are interest rate hedges, including swaps, that will interest rates go up and you have lower yielding securities, lower interest rate securities. They will pay you. They will compensate you for that difference. So but it costs money. I think that's why Silicon Valley Bank wasn't doing it. It costs money to hedge, and they were just trying to maximize their profits, their margins. But there are ways to do it, and they're not hard. And it's kind of banking 101, and all banks, large and small, should be laser focused, and the examiners should be laser focused right now on interest rate risk and the impact it's having on market values of assets that are held in their portfolios.
So Sheila, I have to announce something to you, which, we've been in business for a very long time here at FOLCS. We've had lots of guests. We've had President Clinton and Supreme Court justices and Oscar winners, Tony winners, Academy Award. No, we've had everybody.
I'm honored.
No, I want you to know something. We've never had this many questions.
Really?
We are we're getting hammered. So I'm gonna cut this a little early and take some from the audience, because this is really special and I want to honor this. People really want to hear from you. But before we get to the questions, there is something I want to ask you, because I might want to bring you back, because now that I know that you're also an author of children's books, I've always wanted. We have a series called Conversations on Essential Cinema, where we show an essential film, classic film, and we have a special guest discuss it. So for instance, we had Sharon Stone talking about Casablanca, and we had Matthew Modine talking about 12 Angry Men. And, we've done this over the years. We had Jeremy Schaap from ESPN talking about Chariots of Fire. One time I actually asked Lloyd Blankfein to do something that he looked at me like I was insane. But now I'm going to ask you, maybe we'll bring you back. I wanted to do Mary Poppins. And because I think Mary Poppins is very important, and I wanted you to respond to this, and then we'll get to the questions. Because Mary Poppins, in my mind, created the absolute, it's a slanderous movie against the banking industry.
It kind of is, yeah.
It destroys the concept of finance and lending and loans. The bankers come across as uncaring, bad fathers, bad husbands, stodgy. There's that great song, Fidelity Fiduciary Bank, which has, if I remember, one of my favorite lines is where he says, he's talking about all the good things that banks can do. And I think he says, majestic, self-amortized canals. Listen, all the cool things, bridges and tunnels and majestic, self-amortized. So I just want you to consider maybe coming back one day to
Okay.
examining this film, because I
Yeah.
think it sends the wrong impression of what
Yeah.
bankers do and how important they might be. All right,
Yeah.
let's go to
Okay,
the
very good. That'd be
let's
fun.
go to the
Will
audience.
do. Okay.
This comes from Joe F. I think this might be Joe Feshbach, a Wall Street guy. You said the Fed shouldn't have raised rates, but if they didn't, wouldn't that have signaled to the markets that they were more worried about the banking system than they have been leading you on?
Well, there were some people that made that argument. I think it would just be prudent. Again, it's over 6,000% increase in less than a year in interest rates. It is imprudent to hit pause, assess. There are a lot of reasons. It's just not this is a risk. Rising interest rates pose risk to the financial system. They're a risk that can be managed, but we need to stop and assess to what extent they are being managed, to what extent they are creating any kind of stress in the system. But more importantly, I'm concerned about the real economy too. So when I wrote last December, I wanted the Fed to hit pause. It was more out of concern for the recession risk they were creating in the labor markets. But financial fragility was part of it. But I think it's just prudent. I mean, I saw this on social media. I can't remember who said it, but it was a good metaphor. If you're on a steep hike, sometimes you just need to stop and rest and view, and assess, take your pulse. You still okay? You hydrated, drink some water, maybe. Just stop and assess. That's all I'm suggesting they do. And hitting pause doesn't mean that they won't tighten further down the road. It just means we've done a lot. We need to stop and make sure both the economy and the financial system are able to absorb this. 14 years of lax monetary policy, you cannot just undo it instantaneously. So no, I think that was apparently one of the reasons why they went ahead and did a 25 basis point. But no, I don't think it would have necessarily signaled that. I think it would have said they're being careful and cautious. They want to do a little more research. They want to better understand what's going on. That's a good thing, not a bad thing.
Here's another very savvy Wall Street person who is a long-time board member, actually, of FOLCS. So I'm glad he's on there. Hey, James, it's James Leitner. He asks, since Silicon Valley Bank had 91 billion in hold to maturity securities, why didn't they just repo those in the market or at the Fed discount window? Even if they were worth 20% less than, should have given them 75 billion or so in liquidity. What am I missing? Now, I will say Jim Leitner is really smart and a lot smarter than me. So I actually don't fully understand the significance of that question. Maybe you can explain what he's asking, because a lot of our viewers may not understand, then you can answer it.
Right. So there are facilities, there's a discount window with the Fed. The federal home loan banks will also make loans to banks. They have to pledge collateral for those loans. There's typically a fairly significant haircut on the collateral.
I see.
But there are limits to how much you can borrow. And I just don't know. I don't know how much they'd already drawn. If they had drawn, maybe they just weren't smart enough to figure it out. I don't know. It's a good question. It's just factually, I don't have the facts to answer that question. And they may have been tapped out, or maybe I think, sometimes I remember the FDIC when banks were failing, if we felt it was just hopeless, it was going to have to close, that we would work with the Fed to limit that kind of borrowing, because the more they do that kind of borrowing and then it does fail, all the good collateral, the good assets that the FDIC could otherwise claim to make recoveries are now gone. They're the Fed or the federal home loan banks. So I don't think that was what was going on here, but just a general observation that there are lots of different reasons why you might want to limit that kind of borrowing. But it's a good
does
question.
That mean that Leitner? But does that mean the Leitner's asking a question that's somewhat related to what I asked you much earlier, which is remedies, things that could have been done that may have in fact saved the banks themselves? Is that what he's asking? Or
well, I think he's asking what there are what we call liquidity facilities. The Fed's discount window is one. Federal home loan banks is another one. Where they could have gotten more cash quickly instead of just having to sell those securities outright. They could have pledged them. They would have had, but again, they would have had to take a discount. They wouldn't have been able to get the full face value of those securities. Now they can. There's a new facility that the Fed has opened up. It's a great deal. They can even if the securities lost value, they can pledge it and get a loan at par. So that's a that's a very nice deal, but that was not open. That was not available to Silicon Valley before it failed.
This comes from a gentleman, Stephen Hyamstra, I think is how it's pronounced. And he says, we used to assume, where did it go? Oh, there it is. We used to assume that a rate hike required 11 months to have an effect on the real economy.
Mhm.
What is your assumption about this lag in real effects?
Yeah. Well, that's one of the many reasons. It does. It takes time for this tightening to flow through the economy and have impact. And going so fast, it's another reason why I think they just need to stop. We're not, yes, inflation's still going up. It's slowed. The rate is slow, but it's still going up. But I think the true impact of these very, very fast and big interest rate increases have not been felt. And housing in particular is an issue because there's a big lag between when slowdowns or declines in home prices will actually get fed into the inflation metrics that the Fed looks at and the rest of us look at to determine what the rate of consumer price inflation is. So that is another very good reason why, and I referenced that in my op-ed in December, that this lag that it takes for tightening credit conditions to flow to the economy, another reason to hit pause and just see what's going on before you go
You're
further.
saying we didn't wait long enough on the most recent rate hike to see the effects of that?
I think that they've raised rates really, really fast. And they've been doing that because the inflation data is still significantly higher than their target. And my concern is they're going to overshoot because it takes time for the impact of this interest rate increases to actually have an impact on inflation. So a few months, even without any further rate hikes, a few months from now, we might see a significant slowing.
I see.
Because of this lag effect. And then the other issue is now because the financial system, there's uncertainty around the financial system. This is like going to make banks more cautious in making loans too, and that's all going to also going to slow the economy down.
This comes from, I don't know, just initials, KCL. Stopping the rate increases now will allow the bad loans, especially the startups by these XYZ generation. I think that's a mocking remark. That have never seen a down market and are living on borrowed time with all the free money from banks and venture capitalists, and most not even producing anything but maybe Ponzi cryptos. God, this guy, I love his perspective. All right, shouldn't you keep the rates up to get rid of the excess and let the free market buy out the viable companies and let the bad ones fail already? The longer you maintain the bubbles, the worse it is when it bursts. That's Mr. KCL.
Right.
Or Miss KCL.
Yeah. So the bubbles have been deflating. I don't know about you, but I took a 20% loss on my 401k last year. So, but easy come, easy go. I know those inflated values, especially when tech stocks, they just weren't real. They were just, the growth stocks, they just weren't real. So yeah, I mean, it's again, the question, I'm with you. I hate accommodate. I hate loose money. I've hated the last 14 years. I hate getting up every morning and not people focusing on who's got the best new widget or service or great idea for, some value producing innovation in our economy. What's the Fed going to do today? I just hate it. I want to so get away from it. I don't think our economy should be driven by monetary policy. I think loose money creates wealth inequality. It builds up leverage. It incentivizes risk taking. It distorts capital allocation, all the things you just mentioned in your question. I am with you, but there's only so fast you can go. And I don't want to do this at the expense of a very deep recession. And if we have a financial crisis in particular, they will not have a soft landing. If we have a financial crisis, every single severe recession we've ever had has been brought on, not just because the bare fact that interest rates went up. It was because the financial system couldn't take it, and there was a massive credit contraction, and that's when the economy went into the ditch. That's exactly what happened in 2008 and 2009. I want to avoid that happening again. So yeah, if we have to tolerate a little more inflation for a little longer to avoid that kind of punishment on our economy again, then I think that's just a trade-off. There are no good options here. But I just think they've gone too far too fast. You can only go so fast to undo the damage that's been caused for the past 14 years.
I neglected to mention, Sheila, that we've also had Paul Volcker as a guest. And the
reason did you
that's
really?
Important is because we had him. You'll love this. We had him. We watched with him at the HBO theater, Too Big to Fail. We watched the movie, And then he
Oh,
and I sat
really?
on stage and talked about it. And he was great.
Oh, I
He
wish
had
I
so many
could.
interesting. Yeah, I wish you had been. And the reason I'm saying it because I know he was a dear friend of yours and a mentor of
Yeah,
yours.
yeah.
Is that
Well,
right?
but his book, he
So
wrote about this a lot. He was not a fan of inflation targeting. He thought this 2% was just arbitrary, and it was almost silly, the fixation that central bankers had on 2% inflation. And he talked about the instability, keeping money accommodated for so long for some elusive 2%, worship, and the instability it creates, and you end up, creating the problem you're trying to solve. So the book's called Keeping at It.
yeah.
I'd recommend people read it if they haven't already. I wish he was here now, because I think he would have important insights that we could all benefit from, but he's not. So
So here's a question from an anonymous attendee who does invoke Volcker. So that's another reason to bring this question up. It's got a long windup, but I think it might be worth it. The reason the banks are in trouble because they had so much money to loan out because of free money, and they made so many risky loans to high-risk startups, which 1 out of 200 might succeed. This turned the markets into casinos, which every politician points to as a successful economy. The Fed
right.
is political, as it goes back even to Yellen when she did not start increasing rates when things were good under Obama. So please, Obama, and help Hillary get elected in fear of market corrections. Powell tried under Trump, and a drop in the market scared him to back off. So here's the kicker. Here's the Volcker kicker. Don't you think the Fed should not be political like Paul Volcker did under Carter,
Yeah.
regardless of the politics? Because in that case, we ended up fixing the economy.
Yeah. No, I do. And I think, look, people are just human. And I can't, if the big mystery is why Chairman Powell waited so long to start tightening, it was obvious inflation was picking up, but he was up for reappointment. I mean, I don't know what's in his head, but I know if I were him, I'd be worried about getting Senate confirmation. If I start tightening, that's always politically unpopular, what's going to happen to me. So
Do you
I
think
think
most
there's a
people,
good,
do you think most people know this, that these are appointed positions and that?
yeah, they are. They're not. So the political appointments, you have to be confirmed by the Senate, which can be a really ugly process. It's almost blood sport these days. Back when I worked in the Senate in the '80s, it was a very dignified process, and now it's not at all. So people are intimidated by it. I don't blame them, and I see why he would be thinking he didn't want to rock the boat until he got confirmed. And so maybe we should have just, there should just be one term longer, maybe 7 years, and then, one and done. So you don't, once they're there, they're protected. They don't have to worry about getting reappointed, all these other, political pressures. Because I do think that may have had something to do with why he was delayed, because his nomination was pending at the same time.
I see.
A lot of people think he should have started tightening. So yeah, I think the Fed should be completely non-political. I think it should be, professionals, people who understand monetary policy, but also understand regulation and supervision. That is a big gap at the Fed. They've kind of got one person who understands regulation, Michael Barr. And that's been traditionally, it's like, okay, here's our supervision guy. And we do monetary policy. We got one supervision. He's going to worry about supervision. The rest of us don't have to. And that's just not right. Monetary policy, lax monetary policy, creates financial instability. And if you don't understand those interrelationships, you're not doing your job carrying out monetary policy. So that's something that, the ECB has actually, they have completely separate supervisory board the board is appointing, professional people who understand regulation, have backgrounds in regulation and supervision. Maybe we need to think about something like that. But it needs to be professionalized and completely apolitical. Absolutely does.
But that's a running theme of tonight's Sheila Bair folks headlines, just the idea of managing risk and knowing, the proper oversight.
Yeah, that's right. That's exactly right. Yeah, I understand. Yes, the basics and why that's important.
Yeah.
Why that's important, because that's really important.
Because if
Yes,
you're not doing that, you're not doing your job.
Exactly.
This comes for us from actually one of our board chairs, Jeffrey Lenoble. She says, you mentioned wealth inequality. What should we do to reduce that inequality? And how does that inequality affect our economic outlook for the future? That's a very good question, because people, this is part of the new progressive agenda. Everyone is talking about the wealth gap, right? The huge difference. I will tell you, you can go on our website, Sheila, and watch Volcker tell a very funny anecdote. The whole room cracked up when he said, the big difference is, he said, people today make too much money. You know, he was
It's true,
actually
they
saying,
do.
he said,
It's true.
he got a call from some banker who was complaining. He said, I never got paid anything like this when I was at a bank. And Volcker had the whole room laughing. He said, you know, these people make just too much money. So apparently this is on everyone's mind, either progressives or Paul Volcker and Jeffrey Lenoble. How do we respond to it?
Well, that is, we do a whole hour on that and then some. I mean, I think quantitative easing was a disaster. Let's never do quantitative easing again. Let's get that portfolio wound down. That'll, there'll be some more pain on that, but let's never do quantitative easing again. Let's stop running our market, our economy with monetary policy. It's not sustainable. It's just math. And it distorts capital allocation, and you're not rewarding the companies that are actually producing value. It's just math. So I think that I would start there. I think I think compensation incentives, this whole idea of shareholder value and shareholder alignment, a lot of this, magnificent wealth comes from the way executives are compensated. Is that I've often thought, this is probably going to be controversial and unpopular to some of the people listening, but I've often thought, if banks were paid in debt instead of equity, bank executives were paid in debt instead of equity, how much of this recklessness might go away? Because if they're paid, the lion's share of their compensation is equity, and it is, they have every incentive to increase leverage, take more risk, especially if they're a big bank and know the government's going to bail them out if they fail. So, and I think Mr. Biden's kind of trying to tackle this with more punitive firing and things like that. But I think tackling on the front end, looking at compensation and equity-based compensation, how that incentivizes risk-taking may also be worth looking at. I do think the loose money, the cheap money, the private equity is so much, well, this private, not just private equity, just these private funds generally, the whole ball of wax, because capital has been so cheap, they have just grown like gangbusters. And everybody, the NGOs, the colleges, they're all piling in there. When you couldn't get a decent return on a safe investment, you piled into that. And they didn't have a good place to put the money. There was no productive use of it. So, but it resulted in a lot of fabulous wealth for a lot of people who maybe think they were really smart. I think, or they were just a beneficiary of the Fed pumping a lot of money into the system. But I think so much of this has been caused by loose money. Correct that, normalize rates, make capital cost something, get back to the point where wealth, you generate wealth by producing things of value, not financial engineering. I think that could go a long way. And just one more on that, for people of the lower income, and I mean, the way payroll taxes are so regressive. And then when they start working, the working tax, because they lose all these benefits, the way we provide our safety net is just upside down backwards. It incentivizes people not to work. It penalizes them with lost benefits when they do. That whole thing needs to be revamped as well. And like I said, we could go on those issues for a long time.
But, Sheila, given the subject of tonight's talk, it does fit nicely into the wealth inequality, because when people see bailouts, when they hear bailouts, when they hear, well, wait a minute, you're talking about Silicon Valley multimillionaires, they somehow managed, they were uninsured, and then somehow they managed to be made whole on insurance that was only supposed to cover $250,000. It only deepens people's cynicism about that the inequality gap is unbreachable, and that it's rigged, and that there is certain privileges that wealthy people have that simply never trickle down. No matter what people say, they don't trickle down. And as you said earlier, we wouldn't have this conversation with a community bank. That somehow it's because of the nature of the investors and the depositors that led to this concept of systemic risk that you say is sounding the alarms that should never have been sounded in this instance.
Yeah, no, I do believe that. I do, yes.
Sheila, you've been wonderful. You've raised our game as always. Before we say goodnight to you, we'll just say, I think, of quick announcements. Where are we? For those people that are not already signed up, don't forget, come to FOLCS, visit folks.org and sign up for our email list, and we'll send you information about how to get to see Sheila's hour at the Headline series. You can always watch it with us on our YouTube channel and our website. And Of course, we are a nonprofit. And so we appreciate your donations. We haven't been charging during the pandemic, and we always assume that you walk away smarter. And Sheila Bair absolutely made us walk away smarter. Sheila, thank you so much. We're always rooting for you, and we're always listening and reading you. And maybe
Thank
we
you.
will bring you back from Mary Poppins one day.
Okay, this has been fun, and that would be fun too. So thanks for having me. I enjoyed it.
Thank you, Sheila. I'm Thane Rosenbaum for FOLCS. Good night.